Hello and welcome to Quilter's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and I'm delighted to be joined by regular market commentator and head of fixed interest Richard Carter, and to welcome back Amisha Chohan, head of our AIM portfolio service. Welcome, Richard and Amisha. So we barely had time to digest the autumn budget statement, and we will hear more about that and some of the implications from an inheritance tax perspective from Amisha. But the world moves on very quickly, and of course the main headline event of last week was the US election. And the polls and many political commentators were predicting that result would be a very close call, and indeed there was speculation that it could even take several days before the outcome would be fully known. But it actually turned out to be a very decisive victory for Trump, and the Democrats have since conceded the election. And whilst a Trump victory certainly was unexpected, and indeed he had often been slightly ahead in the polls in the run-up, what perhaps was surprising was the extent of the reaction of US equity markets. And overall, that response was extremely positive, with the main broad-based indices up nearly 5% over the course of the week. There were also very notable divergence between sectors, with financials and private equity up very sharply. JP Morgan was up over 10%, Bank of America up nearly 9%, and Tesla up more than 40% on the day following the election. And in contrast, healthcare and clean energy stocks were down sharply, as were consumer staples such as Coca-Cola and Mondelez. But overall, those winners and losers were very much in keeping with what we might expect from a Republican victory. So, Richard, as mentioned, the Trump victory certainly wasn't a surprise, and I'm going to go out on a limb here and suggest that he's unlikely to contest the result this time round. But the sheer size of some of those moves in US assets suggests the extent of the victory wasn't anticipated. So to start off, what are your thoughts on the outcome, the reaction of financial markets, and the potential implications of the election result? Can politics really have such a meaningful impact, or could this just be a short-lived and somewhat euphoric initial reaction?
Good question. I think the Trump victory and some of his policies are, so sort of different from, I guess, the established consensus in some Western countries that, the long-term implications are very potentially very serious, for markets. So I think it's understandable that there was a potentially quite a big reaction to them. I'd also agree with what you said in the introduction. Trump winning, let's be honest, was not a massive shock like it was last time, but we'd all been expecting quite a close and potentially contested election result, and that didn't happen. Let's be honest, he won pretty comfortably in the end. So maybe markets were reacting to the extent of his victory on Wednesday, and it made the Trump trades, so-called Trump trades, include stronger US equities, stronger dollar and higher bond yields. So it wasn't really a huge surprise, I think, to see markets, those sort of things happening on Wednesday. I think where we go, for now, it's about, the dust has got to settle a little bit. Let's see who he appoints to key roles in the administration. Let's see what his actual policies are going to be. There's often talk that, all the things about tariffs going on European goods and all the rest of it is a big sort of negotiating ploy. So let's actually see what he ends up doing in his administration. But I think there's no doubt that, as I say, he's quite a big change from what we've had over the last 4 years. So there is a potential scope for it to have a long-term impact on markets.
So whilst clearly the US election dominated news headlines last week, there were also key economic events scheduled, with both the US Federal Reserve and Bank of England meeting to set interest rates. And both central banks were widely expected to cut interest rates, and indeed the Bank of England reduced the rate by 25 basis points to 4.75%. And likewise, the Federal Reserve also cut rates by 0.25%. So, Richard, with the headline inflation rate in the UK having fallen to 1.7% in September from 2.2%, and now below the Bank of England's 2% target, we perhaps could have seen a bigger cut, certainly in the UK. Now, I know that there were concerns that the outcome of both the US election and the UK budget could potentially be inflationary. So firstly, what did you make of those interest rate changes? And perhaps more importantly, the accompanying statements from Jay Powell and Andrew Bailey. And secondly, we've also seen big movements in bond markets. And despite that rate cut in the UK, long-dated gilt yields have risen significantly. and last week we're touching 5% and above that current base rate. What has been going on in bond markets, and do you view these moves as a knee-jerk reaction to recent events, or could this signal a more fundamental shift for the outlook for inflation and future interest rate cuts?
Yeah, I think what's been going on in bond markets is that for yet another time in this cycle, investors got their hopes up about aggressive Fed easing, much lower interest rates. Obviously, they started off with a 50, and there was hopes that was going to carry on for some time. Under a Trump victory scenario, that's a bit less likely because, as you say, some of his policies around tariffs and immigration and tax cuts are inflationary. So there's been a reassessment of where the Fed really can go in terms of interest rate cuts, which is why we saw the more sort of cautious, gradual approach from Jay Powell. And also affecting bond markets a little bit as well, particularly here in the UK, has been, there's the old worries about deficits and too much government debt because we had the budget here, which was a bit alarming as far as the borrowing numbers are concerned. So those have been the main sort of two things going on. I mean, in terms of what I thought about central bank meeting, I think it made sense for them to cut rates, but only gradually. We'll see where they go from here, and it's again back to what Trump does rather than what he's been saying. And I think Jay Powell, he's going to have a bit of pressure on him. I think Trump will be tweeting about various things and wanting interest rates to be cut as time goes on. But for now, they've just got to stick to what they can see in the data, in the economic data, and respond accordingly. Where we might be in 6 months when Trump's got his feet under the desk, that could be a little bit different. But for now, they're just going to cut rates cautiously. I don't think in terms of the Bank of England, actually, the Trump victory should change too much because what might be inflationary in the US could actually be deflationary in Europe and the UK if you think tariffs going on our exports. So I don't think the Bank of England will stop cutting because of Trump and may in the end actually have to do more than the market's pricing in.
And finally, Richard, we also had a major unscheduled event with the collapse of the ruling coalition in Germany as Chancellor Scholz sacked a key minister. And this is likely to lead to a vote of confidence in the government early next year. So in addition to Trump's America First policies, perhaps political instability in Europe isn't going to help Ukraine's cause. But is the situation in Germany something you're concerned about? Was there anything else that caught your eye last week, or that you'll be paying particularly close attention to this week?
Yeah, I mean, I think the situation in Germany is a bit worrying. I mean, we had political instability in France as well. You're right, you've got the whole Ukraine thing going on, Trump taking over. Europe probably needs clear leadership, clear and united leadership, you think, at this time. In some ways, though, I mean, this sort of problem with the German coalition has been rumbling on for some time. Again, a bit like UK and US worries about debt and the need for infrastructure spending or investment spending. And the fact that the coalition's fallen apart a bit early, okay, is probably not the end of the world because it means they can have elections as early as maybe January, February, get that out of the way if there's potential replacement government. And then they can be ready to meet the challenge of whatever Donald Trump is going to bring next year. So I think that's probably not a bad thing to get out of the way. Otherwise, I mean, there was some sort of statements out of China last week about details of their fiscal stimulus, which underwhelmed markets, I think. But they'll probably be back to do more next year. This week, I guess waiting for the dust to settle on the US election is the key thing. Trump's visiting Biden in the White House on Wednesday, I think. So that should be one to watch. And we've also got US inflation numbers coming out. So that'll be crucial for the next Fed meeting.
Thank you, Richard. So a really busy week last week, lots of major events, and somewhat that's sort of taken away attention from the budget. So I just want to sort of come back to the budget at the moment. And I'm delighted to be joined by Amisha Chohan, head of the Quilter Cheviot's AIM Portfolio Service. Now, In the run-up to the autumn budget statement, Keir Starmer made it clear that those with the broader shoulders should bear the heavier burden. And whilst perhaps that comment was primarily targeting potential reforms to the non-domiciled tax status, it did also raise some concerns that there could be material changes to capital gains and inheritance tax. And with specific regards to inheritance tax, it was the business relief rules which exempt qualifying AIM stocks from inheritance tax, subject, of course, to a minimum holding period. Now, the worst case scenario would have been that business relief was abolished completely, and that is something that Amisha and I had talked about in a previous podcast during the summer. So, Amisha, that wasn't an outcome I know that you were anticipating, but there was always going to be rumours and speculation, and that has certainly been weighing heavily on AIM shares, and I know that you were prepared for various potential different outcomes. So when the somewhat anxiously awaited autumn budget statement was finally announced by the Chancellor of Exchequer, Rachel Reeves, on 30th of October, it must have come as a welcome relief to all those clients invested in the AIM portfolio service that business relief wasn't going to be abolished. But having said that, Amisha, there are going to be some changes which were announced. So perhaps you could start by outlining those changes for us and how and when they will impact clients.
Hi, Andy. Of course. So you're completely right. We weren't expecting the inheritance tax relief to be removed from business relief qualifying AIM stocks. And so on the budget, what the Chancellor said was that that relief would go down to 50%. So actually, if you are invested in the strategy at the moment, and if you were to hold that strategy for 2 years at the time of passing, your loved ones would still, before the 6th of April 2026, get that 40% relief. However, if you were to pass away after that period, and if you're a new client coming in today, that relief would be at 50%, which would still give you a 20% saving. So there has been 2 changes around this. As I'd said, for existing clients, you can still get that 40% relief up to a certain time. However, for any new clients coming into our strategy, that relief will be halved to 50%. But I think what this does provide is stability. And you'd correctly mentioned that there'd been rumours around this for a period of time. And we did see that impact the stock market. And actually, you did see that relief rally come through on the day of the budget. And it's that stability which is really key.
And prior to the budget, investing in qualifying AIM shares was one of a number of options available to those looking to mitigate and manage inheritance tax. But where tax is involved, there is normally no such thing as a free lunch, and those different options have their own pros and cons. So, as well as those changes that will impact qualifying AIM shares, there were also changes announced that will affect some of those other options. And the one that immediately sort of stood out for me was around pensions. So now, whilst the changes that will impact AIM shares are going to go ahead, some of the legislation surrounding those other areas is still very much subject to further consultation, and we might not know or fully understand the full implications for quite some time. But perhaps bearing that in mind and based upon what we do know at this time, could you talk us through some of the other relevant changes announced in the budget and what this could potentially mean for the relative merits of AIM shares as an inheritance tax solution?
Of course. So I think the main area has been around pensions. And for any of you who are financial advisors or clients yourselves who are given advice by advisors, you've probably been guided towards using your pension as a form of IHT planning and inheritance tax planning. And going forward, so we're talking 2027 from memory, your pension will no longer it will now sit outside the estate, which means that you will have to plan for inheritance tax for that. You won't get that mitigation there. And that's when I think there needs to be more work for financial advisors. So clients should be talking to advisors to understand how they can just best mitigate that. And there are loads of options out there, and an AIM strategy is one of them. And just to remind you of the benefits of AIM, the first point is transparency. It's fully listed. These are listed companies, so you can see the share prices move on a daily basis. You've also got the liquidity factor there as well, which is really, really important because you want to be able to get in and out of stocks accordingly. And so you've got transparency, liquidity, and then the final point is you've got an opportunity for high returns. The market's been challenged over the past couple of years, and actually, as you've heard Richard talk, we are seeing interest rate falls, and actually those interest rate declines really help UK small mid-cap portfolios, and that is where AIM sits.
And finally, Amisha, the primary objective of the Quid Achievia AIM portfolio service is, of course, to provide a solution for inheritance tax planning. And first and foremost, it is great that this will carry on. But looking now from an investment perspective, I know that a key feature underpinning your investment philosophy is that you invest in companies that are fundamentally sound, well-managed, and profitable businesses. And they very much stand up as investments in their own right. The uncertainty of the future of business relief has been weighing on AIM shares, and you previously talked about valuations looking attractive. And indeed, there have been a number of companies that were taken over this year. So what was the sort of market reaction to the budget statement? And just as we saw a significant and contrasting reaction between sectors within the US equity markets to the outcome of the US election, were there any changes in the budget statement that could have a meaningful implications for specific stock or sectors? And might that influence how you manage the portfolio going forward?
Okay, so lots of questions in there. The first point is we did see that relief rally. So going into the budget, AIM stocks were off almost 10% since the election, and we saw a 4% rally on the day. And then that rally slightly continued into the following days, but it's kind of now stabilized. And there's been a number of things in the budget which actually impact whether it be UK equities, and obviously we've had the Trump election win as well. And so if we think about the UK economy and you think about what changes the government is making, so the big one is around NI, and companies will have to pay an increase in NI going forward, and that rate will be lower. So that's going to impact wage inflation over next year. And the way companies mainly think about wage inflation is there's a number of levers that they can pull. So they've got to pay that NI increase as of next year. You've got minimum wage going up as well by 6.7%. So from a company perspective, what companies typically tend to do is look for efficiencies. So find efficiencies where they can use that money to then finance the wage increases. You would probably expect to see if companies have pricing power, you may expect to see an element of pricing power coming through on that basis. And so it'll be, or they have to suffer lower margins. So what companies tend to do is look at those first two levers first before they think about margin reductions. So in terms of the companies that we have within our portfolio, there's only a handful of companies there which will have a larger exposure to that. So that would be the likes of Young's, the pub company, and Johnson Services Group. Both have an employee base which is around the minimum wage level. And so in both scenarios, we would expect that focus on efficiencies to really come through and then pass on any form of inflation in terms of pricing. The second point you'd made was around kind of how do we see the other elements. We have had that Trump victory, and so ways that I'm thinking about that is actually how do we see that impacting corporate tax going forward? Is there going to be any tariffs on any of the companies that we have exposure to which do sell into the US, or actually are they okay because they already manufacture out there? So these are the components that we're constantly thinking about. And I think the key benefit of our portfolio is that we are agile and we can adapt. So when I think about our portfolio and I think about the companies within it, 38% of the companies are solely domestic. So they have full UK domestic exposure, which means that 62% of the revenues actually come from international markets. And so we can tilt our portfolio the way that we want, depending upon whether we want to increase our US exposure, increase our European exposure, increase certain sector weightings, and just be agile with the macro environment, which I think is really important to get the best outcomes for our client base.
Amisha, Richard, thank you very much for your fascinating insights today for what has been an extremely eventful and busy period. And there's certainly a lot of data and information for investors, clients, and financial markets to absorb over the coming weeks. Before we draw to a close, if any listeners have any questions that they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. To stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltachieveit.com. Here you can also see more of what we're doing here at Quilta Cheviot, as well as signing up for upcoming events. And you can also watch past webinars on demand. And we've certainly got a few around the budget and the election. And you can also subscribe to our weekly comment newsletter there as well. We'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. So thanks again to our Head of Fixed Interest, Richard Carter, and Amisha Chohan, Head of the AIM Portfolio Service, and to you all for listening.